Hi, hello, welcome friends. In this video, we are going to discuss about introduction to Ind AS. So, why Ind AS required and how it will used in the accounting and what are the limitations of Ind AS and how we are taken and what is the transition period and what is the roadmap for the applicability of Ind AS and what are the formats will be provided in Ind AS. So, these are the topics we are covering now as of now. So India AS was provided firstly as per the introduction. Here the set of financial statements is mainly key tools for communication of about financial position. Financial position means what is the entity's resources and what are the against claims for the entity, and performance means incomes and expenditure, and what is the changes in position we will discuss here mainly. So based on this financial position, based on this performance, based on this the person stakeholders will take the economic decisions. So according to standards, building block model is the financial reporting world. So everyone required to follow this financial reporting. So accounting standard is mainly essential for building blocking in economic financial reporting, where any accounting standards, what are the principles they are providing, what are the rules we must to follow. So when we are following, we must ensure the accuracy, consistency and comparability of financial statements. Firstly, prior to introduction of this India AS, that ASB accounting standard board was there, and ASB issued various auditing standards, accounting standards to deal various reporting methods were known as accounting standards. So firstly, before this India AS introduction, AS was there, that AS was introduced by accounting standard board, and they are provided applicable to all companies and non-corporate entities also, and to enable free flow of capital across the jurisdiction without increasing any cost or any complexity complaints, along with the need to provide comprehensive guide to deal rising complexities in business world. So for when the accounting standard will work only within the country, so we want to ensure worldwide, so we don't want to more cost increasing or complexity. So we need to change global accounting standards, then we are raised to IFRS. So we seen IFRS, then wait there that after that, in response to G20 meeting, MCA has notified some IFRS. So that G20 meeting, MCA notified some IFRS. This IFRS we are taken directly, we are not taken, we are used to the convergence means we are taken some items and we are excluded from some items, so that will be known as carry in and carry out. So whenever this MCA and ICA are worked extensively together to align some statutory provisions in accordance with concern with India AS to easy compliance challenges for the companies. For that, they are provided Schedule 3 revision extension guidance note. They are provided for the purpose of this IFRS. So all companies, this and AS are applicable to companies other than those following India AS or SMEs or non-corporate entities. Whoever is there, they are provided what they need to provide. So what are the name of accounting standards, disclosure accounting policies, what are the valuation inventories, what is the cash flow statement, what is the contingents and events occurring after balance sheet. So applicable to all companies or those following India AS other than India AS following, and applicable to SME, that is small and medium companies, and applicable to non-corporate entities, that is level 1, level 2, level 3, level 4. So this is the main introduction, where level 1, level 2, level 3, level 4 we will discuss. First, what are the limitations for the purpose of these accounting standards. So these accounting standards limitations was provided here. Mainly the foreign funds are increasing as of now. So if we see this fund accounting or investment banking, so these are mainly for running through foreign funds only, and these foreign funds are mainly increasing. So whenever the foreign funds are increasing, complexities will increase, so that non-explicitly or comprehensive deals by AS will only within India it will work, and then we need some guidance and consistent accounting treatment we need to go. So that when capital is rising in the form of complex financial instruments, so financial instruments we will discuss it in financial instruments separate in the AS they are provided. So in financial instruments we have some convertible or non-convertible debentures, some derivative instruments. Derivative instruments means where the value of the contract underlying will value of the contract will be changed based on their underlying asset, and some group restructuring, complex revenue arrangements, and this all will require some consistent accounting treatments. For that they are provided some guidance. So further we need some comprehensive disclosure in the financial statements. So these are the limitations of accounting standards. These are not provided properly, so they are not explicitly provided about this. So capital, what the capital is rising, what are the derivative instruments, various derivative instruments, what is the group restructuring, what is the revenue arrangements, what are the stock based compensation. So other than normal accounting, fund accounting based, they do not provide proper accounting standards. Now emerging to global accounting standards, we are these different professional accounting bodies where agreement was provided, and nowadays the ICA also entering different agreements with different countries to provide their our services. So if you completed your CA, you can go in other country and you can take their exam by taking some papers exempted, and some other persons will come here, they may go with the practice by taking some papers exempted. So these are provided. Nearly after 25 years of operations, IAF felt need to change its structure, global accounting standards. So 1st July 2000 they are provided some under new international accounting standard committee foundation. So 1st July they introduced one operator under new international accounting standard committee. Here whoever the persons is there in IASB, and for IFRC they are globally standard, they are provided consistent applicant and interpretations will be required, so that from A to India we are consisted. So it is like as in GST we have HSN numbers. So whatever name in one state they may call other name, in one state they may call other names, but when you are using this HN number, this number will be same for all states, so that same like as these ages are maybe different some in cases, but India is so whenever we are following internationally standards, so it will compromise, it will improve our financial reporting, so that we are using. So here mainly two prominent or adopted accounting standards. One is accounting standard set up by US Financial Accounting Standard Body, that is AFA, SB, and IFR. So we mainly taken this IE India is from these two prominent widely adopted accounting standard was emerged. In G20 meeting they are entered different financial ministers and central government countries came under one meeting, and they are decided this standards. Now for need for global accounting standards in India, so that they relay cross-border transactions and free flow international capitals. Whenever we are using same names, so that same numbers, same standards we are following, the cross-border transactions may relay, means other country persons will relay our financials when we are following this India SSR, or we have more opportunities will come across the world, and we can raise the capital in different countries, we can establish our subsidiaries in multiple countries. In past what happened, this compliance cost is increasing. Here we are following accounting standards, whenever we went in other country we need to follow other laws, so the compliance cost were increasing, so that now when you were following India AS, this AS was same for all, and some exceptions will be there carrying out or carry outs. So the compliance cost was decreased. Whatever the added cost, that is complexity or ultimate risk of the both companies preparing financial statements and investors will economic decision will be making easily. Now whenever we are applying these local accounting bodies, there must be some totally different basis amount appearing in the financial statement, so that for this complexity we have these national accounting standards will have small differences and major impact will be there. For example, if a company had made some non-current investments in equity instruments and they are temporarily declining value of investments, so we are in invested in equity instruments. Whenever invested, this entry will be investment in equity instrument account debit to cash or bank. This is the entry we will pass. After some, they are temporary declining value of investment. As per AS, it may be reported to investment at cost. So if you follow accounting standard 13 I think so, it will be recorded at cost but may have to fair value the same as per IFRS. What IFRS says, so we will accounting as per fair value. So the decreasing value we need to account means unrealized loss account or debit to investment in equity entry we will recognize, means that recognizing the loss as per IFRS. So unrealized loss also we need to recognize it as per IFRS. With the emerging need, whatever we are moving from AS to comparable global standards, so we need better it is the investor who are investing, they can take decisions efficiently and faster because the financials are provided as per fair values. Here the Indian companies, due to their limited understandings, accounting framework, Indian such companies to produce such financial information under IFRS. So for the using these commitments, India has made some convergences. Convergence means some carry in and some carry out. So we are not taken directly from this India. Yes, we are taken, so we are included some items, we are excluded some items, we are made some adjustments. Now what is the benefit for using this accounting standards? This is global accounting standards. Whenever we are using this accounting standards, above challenges what are we have, this can be provided by providing the high quality internationally we can recognize our standards. So whenever more persons are using, it has more transparency, it have more accountability, it have more efficient to financial market around the world. For example, if your product is there, this product is 100 rupees in one market, and if you go for the different market and different market also known this product, then the product price will goes up. So whenever our persons was maintaining as per this global standard, the market will efficiently and accountability transferability will be there, and global standards bring transparency by enhancing the international comparability and quality of financial information. And after that, these global standards will strengthening accountability, reducing the information gap. So we do not convert these financials because we are already following the same standards. We do not require to have any gap between the standards. So entrusted their money has a source globally compared information. We have vital important regulatory around the world. Later that, we have economy efficiency will help the investor to identify the what are the opportunities will there, what is the risk across the world. So then they will improving their capital allocation. So capital allocation means they may go with the equity or they may go with the live capital. So some persons may go with debt, some person may go with the equity. Whenever they are going for equity, they will expect more return. Whenever they are going for the debt, they will expect fixed incomes. So based on the risk, based on their risk, they will decide what are the capital allocation we can take. And here better it is for the businesses when you are using the single that is trusted accounting language, then your cost of capital will low and reduces international reporting cost. So whenever multiple countries and they becoming consolidated their operations, tracking operational key performance and reducing number of reporting systems will provided the compliance cost will decreases. So this is the major advantages. So it will accept various jurisdictions also, and whenever we have path of adoption or convergence with IFRS, means convergence with IFRS means we have carry in and carry out. So carry outs are minimal carry outs we are provided. Now what is convergence versus adoption of IFRS? So some common parallels. Convergence to IFRS and adoption of IFRS we can interchangeable. Here we have significant difference between the two. For example, if you take adoption of IFRS means simple terms mean that country applying IFRS would be implementing IFRS in the same manner. So they do not take any risk. So if they tell in IFRS, so IFRS, if they tell inventory will be valued at cost, so they don't change any, as it is they will take in their accounting. So this is from IFRS. This is for example Japan country, there Japan he is taken this, so they will also write their act as per inventory will be valued at cost, so they don't change anything. So this is adoption of IFRS, means as it is we are taking 100% complying the guidelines, it is adoption of IFRS. Whereas dictionary definition of convergence so that say that to move towards each other or meet each other same point from different directions. So here we can do some adjustments. Hence convergence with IFRS means national accounting standard sector would work in IASB to develop high quality of standards. So India was adopted this convergence India SS. So IFRS. So some countries will take adoption of IFRS means whatever IFRS saying, so they will as it is reproduce as per their act. But whenever you convergence IFRS means there are some adjustments they are making. Such adjustments may be some carry in, some carry outside. So here IFRS how if has adapted IFRS with some exceptions, so they will have some exceptions, then it is known as this convergence. Here IFRS, for example, entity is applying IFRS 1. IFRS 1 means first time adoption of Indian International Financial Standards. It is when first asset compliance with IFRS, where our IASB it was taken has it from IFRS. So the entity reporting under the standards asset compliance with IFRS. So whatever their local bodies will cannot asset compliance with IFRS. So they will amend some adjustments. So they will go with some adjustments. Here merely they will not use that IFRS. They can go with some exceptions. The exceptions are regularly looked upon in order to meet the point, and there is no exceptions are left. So some countries like Canada, Bahrain, Cambodia, etc. have adopted IFRS, while countries like India, China, Hong Kong, etc. have converged IFRS. Means these countries will go with the adopted financial statements, means IFRS. They don't change any single word from the IFRS. But these countries, India, China, Hong Kong, these countries they are changing from IFRS. So they are adjusting some, or they are putting some exceptions to IFRS whenever they are framing the law. Next, eighth, process of development and finalization of India. Yes, here accounting standards will be formulated by ASB of ICAI. You know that whenever the central government this will prescribe for standards on accounting, and where they are recommended by the ICAI in consultation with and after examination of recommendations. So here ICAI will recommend, ICAI will consult, and after the examination of recommendations, this NFRA, this is new, this is introduced in last year I think so. NFRA will provide this accounting standards where formulated this one. So central government will prescribe the standards on auditing or amend them thereto. Whenever they are prescribing, they will recommend by the ICAI. So then they will consult, and after they will consult with ICAI, and NFRA will examine that standards. Here MCA will notify the standards under Companies Act and publish in the Gazette of India official gazette. So notified standards are authoritative under India law. Whenever it is noted that IFRS are being issued or revised, this IASB, so accounting standard ASB, and where for IFRS IASB will come into picture. So they will from time to time they will issue, time to time they will revise as part of convergence with IFRS. Means convergence means some adjustments to IFRS or some revisions to IFRS, some issuance corresponding to IFRS. Whenever the IASB issuing any new affairs, IFRS, or updating the current one, ASB of ICA consider convergence thereof under Ind AS. Here they will consult with these local regulatory persons, business practices, what are the taxes and other relevant provisions to develop exposure draft with the proposed to carry out. So this process, how it will process means, here firstly whenever they are starting this IASB will issue. So normally here we see in the flowchart it will better. So IASB, firstly IASB will issue new IFRS or updating the existing one. This is convergence of IFRS. Later after that deliberating and consideration of draft IASB in line with IFRS by ASB. So IASB issue or update, then they will consideration draft will provided by this ASB. After the circulation of the draft to council members of ICA and some specified outside bodies, that ICMA, ICSI, these persons, whatever the parliament body set up by parliament bodies, so they are provided the draft to that persons. And whenever the meeting with representative of specified objective, what are their representatives given this specified bodies, they will ascertain their views. After the acceptation, if they are provided the proper information, they will incorporate their comments from council and outside the bodies and issue some exposure draft for public comments. So they will issue for public comments, and after that public may give some ideas, so recommend some ideas. So they then also their comments will be received on the exposure draft. They will finalize one final draft. So after final draft submitting it to NFRA with the recommendations. So whatever the recommendation provided by ICI, whatever the recommendation provided by specified outside bodies, whatever the explanations provided by the public, these all recommendations will be given to NFRA. Now NFRA, whenever it satisfies, it will notify Ind AS under Companies Act. What is the transition period from AS to Ind AS? So accounting standards to India AS. Whenever the Ind AS will come into picture, and here the one here convergence of Ind AS. So India is using convergence of IFRS. Ind AS means we are taking some exceptions, or we are amendmenting from IFRS, that is carry in carry out. Here MCA has provided some roadmap to implementing the Ind AS, will started beginning April 2011, but this is suspended due to unresolved tax and other issues. In the presentation of Union Budget 2014-15, the Honorable Financial Ministers broadcasting the proposed adoption of Ind AS. So they are trying to start and they are failed in 2014. But in accordance with the budget statement MCA 16th February 2015, they are provided this budget, and they are notified some 39 Ind AS. So totally 39 Ind AS was provided, and they are provided the transition period. What is this transition period? Means whenever we are applying new law from old law to new law, then we have some balance sheet here old law. Now we need to provide this balance sheet as per new. So this is some transition period. Whatever the period here is there, what we can do in this period, this is transition period. So whether we can go for the prospective or whether we can go with the retrospective for different items. So that we are provided as 39 Ind AS was notified as on that date. Here for that 39 we are taking from this IFRS by adjusting some items, and ICI will believe that India is implementing has provided better insight into the financial affairs of the company. So India is reflecting underlying the economic transactions and event in transparent and unbiased manner, and whereas IFRS convergence is a ongoing initiative, so it is not a ending initiative, so it is just a undergoing initiative. It is dynamic in nature. Dynamic in nature means changing nature. So this IFRS always trying to include some items and revising some IFRS on a regular basis. So to avoid some significant changes, they are providing some time period also. For example, IFRS 15 is there. IFRS 15 means in India we have India AS 115, that is revenue from contact with customers. They provided that applicability time. So effective of for annual period beginning on or after 1st January 2017. So while India is 115 applicability from 1st April 2018. So whenever we are taking, they providing the time period also for that India is. So wasn't hence wasn't implemented in advance of IFRS. So we are taking from IFRS means firstly they will go with the IFRS. So firstly IFRS implementing, after that we are taking from that IFRS some adjustments we can make, some adjustment we can add, some adjustment we can delete from that, and we can take from that IFRS. So IFRS 16 leases which was issued in 2019, but in India is 1116 we are taken from 1st April 2019. So the standard will come into first in IFRS, after that we can take from that IFRS India is. What is this about in India is provided? So we are provided that 39 India is now what are there in our syllabus. India AS 101 first time adoption, 102 statement share based payment, 103 business combination. These are all standard. They are provided the standard names and standard names, and how India is been numbered. So they provided in India AS we have India AS 23, India AS 21, India AS 111. So we are taken from series of numbers as per same as IFRS, but in IFRS 1 2 they are using, but in we are using India AS 1 2 3, and after that we will similarly manner as comparing the IFRS, but we are not taking all IFRS because in India we are taking only 39 India AS, but IFRS how more than this IFRS. So whenever we are taking this, because of that we do not have the sequence, so we are taking only some relevant IFRS. So one India AS 1, India AS 2, so we are not taking 3 4 5. So this is not relevant as of now for our country, so that we are not taking this IFRS, and we are taking 7 8, we are not taking 9th one. So we are adapting from same as we in India. IFR 6 is there, IFR 3 is there, IFR 4 is there. Whenever we are starting, then they are providing some transition period for the applicability. Here we can see number of IAS are retained same as IFRs only, and total reporting. What is the IFRs representation committee was saying? Interpretive body of IASB. It main work to address application issues and suggest some official IFRS interpretations, so that eventually approved by IASB. This IFRIC and numbered IFRC 1 2 etc. interpretation will be before 2003. Now how India AS will be structured? So for the structure we have one objective. So what is the objective of the standard? So example, following India AS 2. So India AS 2 talks about inventory. Objective, what is the objective of India AS 2? Prescribe accounting treatment for inventory. So this is the objective, and primary issue in accounting for inventory is the amount of cost to be recognized as an asset and carry forward until the related revenue recognized. Means here inventory means what? This is asset. How much time this will exist in the balance sheet? Up to we can recognize the revenue, this asset exists in the balance sheet. So how we can carry forward that until revenue recognition? This standard will provide that objective. Now including any write off is there, net realizable is there, it is provide guidance on cost formulas using the against cost of inventory. What is that is objective. Next, scope, how much it will be applicable, whether this applicable to all, means for example applicable India is applicable to all inventories except financial instruments, it will deal separate standard. Biological asset, it will deal separate assets. Separate India is there 41. So whenever we have separate standard, then that the separate standard will deal the items, this general standards will not deal, and after that they will provide some definitions, various terms they can using in that standard. For that standard they will provide the definitions and contents of the standards. Main principle of the standard is to recognition, measurement and subsequent measurement. So whenever we are doing the standard, that standard will divide into, they will provide some terms definitions and how can we recognize, how can we measure, and subsequently what can we measure. For example, if we take PPE, property plant and equipment, so PPE means they will provide the definitions. Asset means tangible assets, means whichever the items using for the administrative or whichever the item will provide economic benefits, using that asset we are providing the economic benefit, that is known as a PPE. Means here the definition, they will provide some definition. And for the recognition, so first we need to recognize only on cost model, and subsequently we can go for the cost or revaluation model. So they will provide, and we need to disclose some items. So whenever we are changing, means we have 5 items, that is asset, liability, income and expenditure. Another one will be equity. Whatever the changes, in changes may be qualitative, quantitative, we need to disclose that items. And transitional provisions and effective date. Transitional provisions and effective date means whenever we are taking some standard, the standard will provide the effective dates. Means if we see income tax with effective from this date, with effective from that date, so this is the effective date they are providing. And appendix, some explanation they will provide as per the industry specific, some guidance they will provide, some different terms they will provide, some references they will provide, and some comparisons will provide with IFRS, and some cases will applicability relevant respect to standards, what are they will be provided. Now roadmap for the applicability of India AS. So on dated 16th February 2015, they are notified 39th India SS, it is known as. But in this we have in roadmap for this applicability, India has transition roadmap companies and non-banking companies, so it will applicable to all companies and all NBFC, but they are excluded banking companies and insurance companies. Means India is applicable to all companies and NBFCs, non-banking financial institutions, except bank and insurance companies. So India is not applicable to banking companies and insurance companies, they will applicable to their regulatory. For and they provided the transitional period. For that we need to with effect from, means with the date is applicable to this India SS, we need CC. For that we have provided the 4 phases level: phase 1, phase 2, phase 3, phase 4 for listed companies. So if the company is a listed companies, if as per the phase 1 they provided phase 1 for accounting period beginning will honor after 1st April 2016, 1/4/2016 to 31st March 2016. So this is the period whenever we have our company is listed, already listed or are in the process of listing, and having the net worth of 500 crores or more. So even 500 crores or more net worth is there, then we will applicability of this India SS. And companies other than India means other than listed companies, then net worth having 500 crores or more, then applicability. So up to 500 crores is there, the company is a listed or process of listing, it will be applicable. And more than or equal to 500 crores, if we, even though that is unlisted company, it will applicable to India AS. And whereas if the companies have holding subsidiary, joint venture or association of above these 2 companies, then India AS is applicability. Here whenever we are applicable India AS, we need to file or we need to report 3 balance sheets. So firstly phase 1 applicability will start with 16-17. For that regularly we will provide 31st March financial statement, and we need to provide one comparative statement regularly. So this is mandatory for whenever we are going with these changes. Some cases we provide some retrospective effect, then we need to provide, or whenever we are restating our financial statement, we need to provide some opening balance sheet. So for phase 1 companies, who is the companies is there in phase 1? Listed companies and unlisted company who are greater than or equal to 500 crores, and their holdings, associates, subsidiaries, joint venture. These all companies will require to provide the 31st March 2017 financials and compare to 31st March 2016 financials and one opening balance sheet as on 1st April 2015. This is phase 1. And whenever we have phase 2, in phase 2 it will be applicable to 1/4/2017. So phase 1 will be 1/4/2016 to 17, and phase 2 will be 1/4/2016 to 17. 1st April 2017 to 31st March 2018, ending with there. So here we need to provide the comparative and financial statement and opening balance for 1st April 2016. Here which companies they can, whenever the company is listed and net worth is less than 500 crores. So companies equity debt listed or in the process of listing any stock exchange outside India having net worth less than 500 crores. So if the entity is having less than 500 crores, if the company is unlisted company, unlisted company, then if it has 250 crores or less than or equal to less than 500 crores, then they need to, it will be unlisted company to greater than 250 to less than 500. If company is in listed or in the process of listing, net worth of less than 500 crores, it is applicability, and holding, subsidiary, associate, joint venture of these above companies will be applicable. Here when this phase 2 will be applicability, then they need to provide 31st March 2018 financial and comparative of 31st March 2017 and one opening balance of 1st April 2016. Here Ind AS would not be applicable to company other than listed company whose net worth is less than 250 crores. If the company has less than 250 crores, Ind AS will not be applicable. So up to 250 crores, no applicability of Ind AS. So they need to provide their financials by using the accounting standards itself. So they need to continue to follow accounting standards. Now they provide some key matters and transitions. What is there in key matters in these transitions? They provided comparative financial information. Comparative financial information means whatever the companies, all companies applying Ind AS, they need to present some comparative information as per Ind AS for 1 year and comply this requirement also as per the Ind AS, and Ind AS will begin applicability for the beginning of the previous period. For example, they provided company adapted Ind AS. So if the company want to apply their company voluntary basis, they can go for the voluntary basis will be allowable. So for example, adapted Ind AS from 1st April 2024 for its accounting period 4/5, and hence it is will be required to prepare first Ind AS financial statement for 4/5 because they are want to adapt that financials as per Ind AS, and they need to provide additionally comparative statement. So it is mandatory, every company will provide this mandatory, but for the date of transition they need to provide additional opening balance sheet, that is 1st April 2023 balance sheet. So they are providing 3 balance sheet as on date, so 5, 4 and 1st April 2003. Ind AS applicability as per the above first I mentioned, MCA notified company whoever Ind AS is using applicability, then they need to prepare the first set of financial statement in accordance with Ind AS effective at the end of the first financial period. That is example number 4. They are provided one company is adapted Ind AS 1st April 2004 for its accounting period 4/5, and hence it shall prepare, means it is mandatory to prepare Ind AS for financial 4 and 5 by applying all Ind AS due effective from as on 31st March 2005, and we need to apply this Ind AS consistent basis. So whether the company is apply all used following this Ind AS voluntary basis or mandatory basis. Mandatory means we are provided that phase 1 phase 2 na based on that phase 1 phase 2 mandatory. If the company wants to go with the voluntary, they it also allowable. Whenever they are following whether mandatory or voluntary, they need to provide the consistent application of Ind AS, means they don't change, does not subsequently apply it. Here Ind AS is applicability for Indian group companies. So we are seen in both the phase 1 phase 2 holding, subsidiary, associate, joint venture, all they are included. Ind AS applicability for overseas group companies also. Whenever the issued company MCA, that is overseas subsidiary is there, associate is there, joint venture, other similar entities is there, may prepare its standalone financials in accordance with requirement of specific jurisdiction, and provided such Indian company shall prepare its consolidated in accordance with Ind AS. So if we have either voluntary or mandatory criteria, and whenever Ind AS is applicability for standalone and consolidated financial statement as per class 3, MCA will provide complied with accordance with the rules shall apply both SFS and CFS. So we will discuss in separate standards will be there for that. So for we are taking the net worth. What is mean by net worth? How we can calculate the net worth? Because for calculation of net worth, they provide class 57 of section 2 of Companies Act. So as per this definition, they are provided aggregate of paid up share capital. So we need to aggregate paid up share capital plus whatever the results is there, all the results created out of the profits, and we need to add the security premium. So from that we need to deduct aggregate value of accumulated losses. If they have any losses, we need to deduct. If we have any deferred expenditure, so preliminary expenses is there, we need to deduct. If we have any miscellaneous expenditure not written off, that is preliminary expenses which is the expenditure incurred before incorporation, the type of expenditure is there, we need to recognize, and but does not include reserves created out of revaluation assets, return back, depreciation and amalgamation. So only the realizable values will be considered here, not realizable revalued figures. And further it is clarified that net worth shall be calculated in accordance with the standalone financial statements of the company as on 31st March 2014 or first audited financial statement for accounting period. If we are started after that, we need to take the first audited financial statement. If we are existing firm, we will go with the 31st March 2014. If company is not existing before it, then we will go with the first audited financial statement. For example, they provided first company meeting. First company meeting is net worth threshold for first time as per financial statement year and 31st March 2017. So shall apply Ind AS for the financial year 17-18 with comparative will be provided 16-17. In this roadmap, whenever we are providing this 16-17 and 17-18, 1/4/2016, that is transition period, we need to provide the opening balance sheet. So they provided one illustration here. So what is there in illustration number 1? So in illustration number 1, they provided following is snapshot of audited balance sheet of company A. So company A balance sheet they are provided, and company A is a listed company. So if the company is a listed company, then they will applicability of Ind AS is mandatory. And when they are provided the liabilities and assets, so equity share capital 160, security premium 200, general reserve 150, revaluation reserve 40, net profit and loss 75, liability 160, and they provided the assets 455 fixed assets, investment 200, current assets 50, miscellaneous expenditure not written off 80. So as per the roadmap, which phase company A falls, and will your answer will change if the company is unlisted company. So here we need to calculate, first we need to calculate the net worth of the company. For net worth, we need to take equity share capital. So equity share capital means 160 we will take. After that we have any reserves or general reserves or security premium. So 200 plus 150 means it will become the 350. And after that revaluation reserve. So revaluation reserve we will not consider because it is revaluation, it is not a realized value. And profit and loss means realized value. So 75 we will consider. And after that we need to deduct whenever the preliminary expenditure or miscellaneous expenditure. So this provided some miscellaneous expenditure 80 rupees. So what is the total? 160 plus 350 75 minus 80, it will become the 505. So they are exceeded the 500 crores. So now is the company, so they provide the 505 the as per net worth, or as per section 2 class 57 of Companies Act. 505 is the net worth. Now we do not consider that revaluation in the calculation of net worth as per the definition. The company is listed, so it does not meet the net worth threshold 500 crores, and hence it would be covered under phase 1. So whenever the company is listed, it will be covered in listed companies. So phase 1 will be applicable to, whenever phase 1 is applicable, India AS would be applicable for that company beginning on or after 1st April 2016. And even if the company is a unlisted company, net worth is more than 500 crores. So for more than 500 crores, phase 1 will be applicable. So beginning from on or after 1st April 2016 itself. Next, illustration number 2. So in illustration number 2, they provided same as above. The balance sheet of profit and loss account is negative 375 when Ind AS should be applicable to company A. Now if it is negative balance, the balance of profit and loss account is negative. Net worth will, whenever we are added that 55, we got that 505. Now we will take the debit balance of profit and loss of, if we deducted, hence it does not meet the criteria of phase 1, so it will become less than 500. I think it will go with the above 250 crores. So now if it is a company, listed company, it will irrespective of the covered phase under phase 2, has first criteria of phase 2 say that company whose equity or debt securities are listed or in the process of being listed on any stock exchange in India or outside India having net worth less than 500 crores. So it will come under phase 2. Hence India AS would applicable to company A for accounting period on or after 1/4/2017. So first phase will be started 1/4/2016 and second phase will be started 1/4/2017. Now if a company is an unlisted company, India AS would not be applicable, because unlisted company only when it has more than 500 crores it will be applicable. Next, illustration number 3, net worth of company B. It is unlisted company and unlisted company turnover net worth is 600, so it is exceeded 500 as on 31st March 2014. However, due to losses incurred in financial year 14-15, the net worth of the company was 400 crores as on 31st March 2015. So applicability as per firstly they are in more than 500 crores, but later it was decreased for when company B will applicable India AS. So it is unlisted company for a year. Net worth as and cut-off date. So cut-off date it will be 31st March 2014 they are seeing. So because the standards was came into existence that 15th 2015, so greater than 500 will be there on the cut-off date, which suggests that it should be covered under phase 1 of the roadmap. So for that roadmap, the question may however arise in mind that since the net worth on immediately preceding year end was 400 crores, would company cover under phase 2 of the roadmap? So firstly, as per the cut-off date, it will come under phase 1, and next year it was decreased, it will come under phase 2. That is the question here. It may be noted that the net worth shall be calculated in accordance with the standard financial statement of the company as on 31st March 2014. So if it is a existing company, we will see the 31st March 2014. If it is newly company, we will go with the first audited financial statements, so that accordingly the net worth threshold criteria for a company are once met. If it is once met, then it shall be required to comply in irrespective of the fact later on that the net worth will fall below the criteria. So once it was meet the criteria of net worth, the company should follow that India AS, even though the net worth of the company will decrease later. Now in view of the above, the company will be required to follow India AS for accounting period beginning on or after 2016. So for that they need to provide the cases. And here illustration number 4. In illustration number 4, they provide the net worth of the company C. An unlisted company was 400 crores. So this is 400 crores on 31st March 2014. However, the net worth of the company was 600 crores as on 31st March 2015, from when the company will be applicable. So here similarly issue 1, which is given reference to class 2B of notification, wherein it is satisfied that for companies which are not existent on 31st March 2014 or an existing falling under any threshold of first time adoption of after 2014. So if the company is in existing company, we will see the existing net worth. If the new company, we will see the first audited financial statements. Now here they provide the company which is in existing first time after 31st March 2014. The net worth shall be calculated on the basis of first audited financial statements. So if we are seeing after 31st March 2014, we will go with the first audited financial statement ending after the date in respect of which meets the threshold specified in sub rule. So hence any company that meets the threshold has specified in the company, that is in particular financial year, Ind AS will be applicable to such company immediately next financial year. For example, year and cut-off date 31st March 2014, it was 400 crores, means which is not come under the eligibility. So whenever they are not required to come, and then we will go with the next first audited financial statement which has the specified turnover next what was came into picture. Now whenever the company specified threshold is met, then it is immediately next financial it will be applicable. Hence in the present case, company C is covered phase 1 of the roadmap, and accordingly Ind AS will be applicable company C for accounting on or after 1/4/2016, for beginning on or after 1st April 2016. Now illustration number 5. In illustration number 5, they are provided one company D, and this company D parent of company A. So parent and company is the parent company of group A, and group company A is unlisted company having net worth of 60 crores. So it has 60 crores as on 31st March 2014, means which is not met the threshold limit. Following are other companies of group. So in that company, how this company subsidiary of company B is there, subsidiary of company A, and company C is there, it is subsidiary of company B, and it has 600 crores, means which is more than 500 crores, and 150 crores it has less than that 500 crores, means whenever we have company exceeding 500 crores, that company will be applicable to Ind AS. So for here the company A is 60 crores and C is 150, means they are not met any net worth criteria. So A and C unlisted company does not meet the exceed the net worth criteria. However, net worth of company B exceed the 500 crores, that is 600 crores, it will cover under phase 1 of roadmap. So whenever exceeding the 500 crores, it will come under the phase 1. And as per Ind AS be applicable to company B, the parent company of company B, that is which is the parent company company A, and subsidiary of company B, that is C, is they also would also get covered under Ind AS irrespective of the net worth criteria. Even though company A is not met, even though company C is not met the net worth criteria, because of company B met the net worth criteria, is 3 companies required to applicable all Ind AS, and they need to prepare as per accounting their Ind AS. And company D provided here, company D is subsidiary E, and company H is subsidiary of D, and company F they are provided, and these all companies is there, and all these companies, company is the main company here, company is the associate company, and all are unlisted companies, and whereas company E has 300 crores and net worth unlisted net worth of all other companies is below 250 crores. So only this E company has more than or equal to 250 crores. Here, as mentioned in the companies rules 2014, if India is applicable to one company, it will be applicable to all its holding companies, subsidiary companies, associate companies, and joint venture companies applicable to one company. Now here company is above 250 crores, so it is covered under phase 2. So whenever it has 250 above and it is unlisted company, it will come under phase 2. Now whenever it is applicable its subsidiary, who is the subsidiary is here. For this subsidiary it will become the E company, so its subsidiary will be applicable, and associate company will be applicable. So associate company is G company, so company E, their company is subsidiary of company B, associate is G, so but both companies is applicable, and company D is also applicable India ISS, but this companies H is not applicable because they are not the subsidiary of company E. Only this D, G, F, E is applicable in the S. So with respect to other companies of the group, following guidance is given. That is, it may be noted that India S applies to holding, subsidiary, joint venture, associate of the company. Here of the company ante means this is this company which is the applicability company is there. For that company subsidiary, for that company's associate, for that company's holding company, we can see only this company. Half the company means this exact company will be considered here, so that we meet the net worth listing criteria. This requirement does not extend to another fellow subsidiaries. So another fellow subsidiaries is not applicable to net worth criteria. India S is not required to prepare as per India S, and holding company will be required to prepare separate SFS and CFS mandatory under India S if one of its subsidiaries meets the specified criteria, and therefore such subsidiaries may be required by the holding company to furnish financial statement as per India S for the purpose of holding companies consolidated India S. Fellow subsidiaries may however voluntary, so they do not have the mandatory. If they want to go with the voluntary India S, they may allowed. Here other companies group company H and company I would not be covered under India S. However, as mentioned, company H and I, if they want to go with the India S, they will be allowable. So however, though statutory company H and I continue to prepare financial statement under A. So if you are not applicable India S, they will continue with the accounting standards. If they want to go with the voluntary basis, they can adopt the India S. They are allowable. Next, illustration number 7. What is there in illustration number 7? In illustration number 7, ABC Incorporate is there. In ABC Incorporate, they provided that they have net worth foreign company. Here one company is incorporated foreign company. Foreign company means which is a company incorporate outside India. Body corporate incorporated outside India, and their branch or one agent is conducting business in India. That is foreign company means it is not registered as per Companies Act 2013 or Companies Act 1956. So it is not a company as per our act. So its net worth has 700 crores, and it has two subsidiaries, company X which net worth is 600 crores and company Y net worth is 150 crores. So as per this, company A is there and company X is there and company Y is there. This X company net worth is 600 crores and Y company net worth is 150 crores. So normal cases, whenever the subsidiary company is applicable and this company is required, holding company is also required to prepare its financial as per India. But here similarly has been dealt, IFHE rules provided some. Company X has net worth 600 crores means it has more than 500 crores, which is required to prepare its financial statement accounting period commencing from 1st April 2016 as per company's rule 2015, while company Y having net worth 150 crores would require to prepare as per India accounting standards, means because they do not have the net worth, they did not meet the criteria, net worth criteria, so they need to prepare as per accounting standards. But here, since foreign company ABC Incorporated is not a company incorporated under the Companies Act 2013 or earlier Companies Act 1956, it is not required to prepare its financial statement as per the companies, and as the foreign company is not a required to prepare financial statement based on the India. So net worth of foreign company is not as per the Companies Act section 2 class 57, I think so, net worth definition they are provided. So as per that, it is not required to prepare their financial statement as per these cases. And whereas for we are completed phase 1 and phase 2, and after that we have two phases, one is phase 2 and phase 3, where NBFC, which is company, NBFC non-banking finance company, which is registered as per section 45I of RBI, which is having certificate of registration from RBI, and which is include some house financing companies, merchant banking companies, microfinance companies, mutual banking companies, venture companies, reconstruction companies, mortgage guarantee, core investment companies. These all come under the NBFCs. These NBFCs will applicability of India in two phases. So up to India is started from 1/4/2016. This is phase 1. 1/4/2017, this is second phase, and 1/4/2017, this is 1/4/2018, this is third phase, and 1/4/2019, this is fourth phase. These two phases for NBFC and these two phases for companies. These two phases what they are explaining here means the company which is on or after 1st April 2018 with compared to for the period ending 31st March 2018, and which is having more than or equal to 500 crores net worth of that NBFC, and which is holding subsidiary, associate, joint venture, they need to prepare their financials as per Ind AS. So it will be the ending financials. We can see this net worth will be useful, and for that 31st March 2019 they need to prepare as per Ind AS, and opening balance compared to they need to provide, and one opening balance sheet will be required to prepare. And this is first, second, third phase, and fourth phase will be company from 1st April 2019 where equity debt listed or in the process of listing, and where the less than 500 crores, if you have less than 500 crores, and unlisted company greater than or equal to 252 and less than 500 crores will be applicable from phase 2, and if they have any holding subsidiary, associate, they will come under this picture. So phase 2 will be they need to comply 31st March 2020 financials as per Ind AS, and its comparative and its opening balance sheet they need to provide. Here below 250 is not applicable any NBFC Ind AS, so they will follow as per accounting standards only. Here also the provided the calculation of net worth. So for the purpose of calculation of net worth, for determining applicability in Ind AS, following principles will be applicable for these cases. So for the net worth we need to see calculated according with the standard financial statements of NBFC as on 31st March 2016, whereas for companies we are taking 31st March 2014 financial statement as the base year. For NBFC 31st March 2016 is the base financial year, or if it is first audited financial statement if they are started after the 31st March 2014. If it does not exist, they will go with the first audited financial statements. So explanation they are provided. Application of Ind AS to non-financial company whose parent, subsidiary, associate or joint venture is NBFC. If you are any associate, joint venture, associate person, then also it will be applicable to joint financial statements. They are provided one illustration 8. So in illustration number 8 what they are provided, illustration number 8, as per the roadmap Ind AS is applicable to company X for financial year 17-18. So they provided financial 17-18 Ind AS is applicable company X. Company X is non-finance company and it has one subsidiary Y. So X is the company and it has one subsidiary which is Y, and company Y is unlisted NBFC. So these are applicable financial 17-18, but for NBFC it will be applicable after 17-18. So as on that date company Y is not applicable to Ind AS. and which is having companies a net worth 400 crores. So what will be the date of applicability of Ind AS for X and Y? If the Ind AS applicability date of parent NBFC is different from the applicability date of corporate subsidiary, then how it will be consolidated? So as per the in accordance with the roadmap, it may be noted that NBFC net worth is less than 500 crores. What is the net worth? Less than 500 crores. So it will be applicable from 1st April 2019 onwards. So further, the holding subsidiary, joint venture or associates of such NBFC other than those covered by corporate roadmap shall also applicable for Ind AS 1st April 2019. So applicability, company Y shall apply Ind AS for financial year beginning April 2019 with comparative of 31st March 2019. So they need to provide this beginning 1st April 2019 with comparative for the end 31st March 2019. And company X shall apply Ind AS in its statutory individual financial statement from financial year 17-18. So however, for the purpose of consolidation by company Y financials for the financial year 17-18 and 18-19, and company Y shall also prepare financial individual financial statement as per S. So here company Y is need to prepare as per S and as per India AS, that is provided. And after that, India AS for banking and insurance companies. So for the banking and Indian insurance companies, India AS is not applicable, as and yet they are not yet provided. So they are says that India AS is applicable but not yet notified which date is applicable. So as and that they do not have any cases. And as per India AS roadmap for mutual fund, they need to follow time to time. They are provided, they are protecting from 25th January 2022, they are provided the guidance will be prepared in accordance with India AS. So additionally, SEBI has provided 4th Feb 2022 provided some guidelines also. So they are provided some specific format for mutual funds, and they will applicable from 1/4/2023. So this is applicability. So first phase will be 1 to 2016, second phase will be 2017, 18 third phase, and 19 fourth phase, and for mutual funds it will be 23. So from 23 it will be applicable. 1/4/2023 means this year it will be applicable. So, and they provide some relevant sections. They are provided section 2 class 22. It is for accounting, which will be applicable for 133. As per 133, central government will prescribe the accounts where it has some NFRA will notify the standards, and 123 will provide that financial statements. So financial statement will provide under section 123. It will be required 120 as per true and fair value, and as per 133 we need to follow the accounting standards. And 134.5, which is director responsibility statement is there, and the director responsibility statement where they need to provide the proper explanation, or if there is any material departure they will need to provide the reasons. And 143 will, which is provided the opinion whether the financial statement will comply with the accounting standards. And as per that 143 only we will provide that CARO companies companies auditor reporting one there. And 230, which is power to compromise or making some arrangements, will be provided. And section 67, reduction of share capital, if there is no application or for reduction share sanctioned by the tribunal unless accounting treatment proposed by the company, such reduction is conformity with the accounting standards. Some relevant SEBI guidelines they are provided, and after that some terms they are provided as per format. What is the format will be provided in schedule 2, we will discuss in next video.